momentum has been the strongest force in the market, and it's hard to neglect it. Therefore, we are still involved. Not all of them, because it's not Magnificent Seven anymore, we all know. But on the other hand side, there will be a time where they are just priced too perfect.
Momentum is a good keyword because we want to talk about a Max 7. Is it now time to reduce Max 7? Is the momentum gone?
Absolutely.
We've got an absolutely.
Not sure.
Not sure.
One has to differentiate.
Yeah.
Why is the time over now for Max 7?
I think that in general, if you would have NVIDIA, you basically own the stock market. If you look at the comparison, the relative value of the S&P 500 to say an equal weighted S&P 500, it's the latter is barely half of the performance of the capital weighted. So from that perspective, I just don't want to argue whether that's a growth story. I would even be tempted to say it's been more quality than growth, right? So it's not exactly the fiscal and monetary policy which help these companies. They are at these levels for a reason. But keep in mind, we now have 2 to 3 companies which are in excess of the 3 trillion mark. And the 3 trillion mark, just for one of them, is double the size of the entire German equity index, which is the DAX. So, of course, they're making the money, they're earning it. But the expectations which are baked in those prices are excessively, and it will be really hard to match those expectations, and that will be harder day by day.
And this is why I say I'm not sure, because I clearly see this point, and on the other hand side, there is still the momentum we talk about, and I think this earnings season will give us more insights into what has happened and what will be happening over the next maybe few months. Therefore, I think it's important to look at the earnings report we get, and so I'm really mixed, because as you said, momentum has been the strongest force in the market, and it's hard to neglect it. Therefore, we are still involved. Not all of them, because it's not Magnificent Seven anymore, we all know. But on the other hand side, there will be a time where they are just priced too perfect. And this will be questioned by the market.
Absolutely, but the question has been more kind of reduce, not completely sell. So from an overweight or underweight perspective, I would say it's basically a good time to to decrease the relative weight, go slightly underweight, and see where things go from there. There are good points, and of course those drivers are still dominating the investor behavior. No doubt about it. But sooner or later, there will be a day of reckoning whether those valuations are justified. And again, we haven't seen that many companies entering the market, and challenging NVIDIA so far. But that definitely will come.
There's one special situation we have to take into account too, and that was during the Corona crisis, the technology and companies, they all had a nice boom, and then they fell into kind of an earnings recession thereafter. And what we have seen since mid of last year effectively is that they recovered with their earnings from this earnings recession. Therefore, the technology sectors, the growth sectors in the US showed earnings growth on a quarterly basis year over year, kind of 20%, 30%, while the rest of the market did nothing. And that started to change with the Q2 reporting season, where basically now this year-over-year earnings growth from these technology sectors and so on is coming down, while for the rest of the market it's rising. And overall, basically the earnings growth is almost the same now and is expected to stay that or even rise for the rest of the market in the next quarters. So it's a much broader earnings growth, and therefore one should also expect the market breadth to rise, and that's what we have seen over the summer already, and we would continue to bet on that.
Correct.
We actually bought the Russell 2000 because of that. And I guess we will build up the position maybe in the next couple of months as business cycle data hopefully will start to improve further on. And I think that's then the moment when the broader economy will really benefit from this stabilization. And that's maybe a good point then to increase even more the Russell 2000 exposure.
And there's a turbocharger, which is Trump.
Yeah,
So
exactly.
If there is a Trump administration in place, you have seen that because they were catching up in a few days, where when the probability was very high after the assassination attempt, and Trump going there, basically the Russell 2000 catched up to the S&P 500 in just 2 days, and therefore we also become a little bit more optimistic on the smaller mid caps, more in the US than in Europe right now. I think in Europe it probably needs a little bit more time. The earnings trend is still quite negative, but I think for 2025 that small mid caps could be actually quite a good opportunity, given that we have a historical valuation discount to large caps. I'm a little bit more optimistic on the tech side, to be fair. Because at the end of the day, it's going to be the earnings momentum and the earnings trend, and I don't see really a massive deceleration because of the AI boom. And actually, if you have seen the CEO of NVIDIA, he's basically saying the demand is insane, for the new chip. So I just don't see, I'm not so negative that the demand will decrease so heavily. And on the valuation side, yes, you have in the Mac 7 some 30, 31 in terms of PE ratio. That's ambitious, absolutely clear, but it's not excessively, from my perspective, ambitious, given that if you look at the history, that was actually quite often the case. And if you go back in the situation at the beginning of 2000, where we had the internet bubble, the top 10 were valued at 71 or 75 in terms of PE ratio. They are now valued at some 30. So we are just, from my perspective, far away from being excessive in terms of valuation.
I'd agree with that, and certainly I think you need to sort of differentiate between within technology. NVIDIA is making the chips, right? And you can make there are real profits being generated, real sales, real profit being generated, for them through the AI boom. I think the interesting question would be more broadly across technology. Given the amount that other technology companies are spending on AI, they're spending on the chips, are they going to get a return on that AI investment, right? And it's still a little early to sort of tell who's actually going to extract that return or not. And I think that's where we're going to see kind of a bigger dispersion, more broadly across the tech sector.
Plus ETF money does not care about earnings probably, right? It's just like flowing in and making the bigger or the big bigger.
But it can also flow out.
On that side, the trend towards passive is unabated. It's just continuing, and it has to do mainly in the US with the 401 pension schemes. The background is that the baby boomers, they did basically save in these pension schemes with active funds, and they are now selling them because they have retired, and the young generation is saving with kind of index products. And we can measure that each month. When you look at the fund flows, there is not one. I think there was in 2020 or 21 one quarter where active had more inflows than passive. But usually you have kind of 100 billion per month outflow out of active, inflow into passive on these EPFR fund flow data. It's per quarter.
There is a nice statistic I just saw recently which describes how the generations invest in actively, passively, robo-advisory, etc. And this says that the younger generations invest their money 50% to robo-advisories. So this is really supporting the ETF trend, while the other generations are more active and less passive. So there is a huge change in the generations.
And the funny thing is, even active funds, active products are getting more passive. We have an econometric tool at OGAW where we basically monitor the tactical allocation, tracking areas of actively managed funds, and even they are getting more passive. They are getting closer to the benchmark all the time. So there's a general trend towards that development.
Well, it's interesting listening to what my colleagues all said, because for several reasons there are a lot of points where I would say I agree to disagree. For example, if we talk, I listened to what Johanna mentioned with bonds to equities. We've seen correlations going up, especially when everything's going down. So you're all been talking about bonds to equities most of the time. We found out that This is obviously not sufficient, depending on the mandate that you have from your client. But that's the reason why we heavily make use of hedge funds, volatility strategies, commodities, precious metals, you name it. And if you're really running for return, then there's no way being out of something new, which might be digital assets as well as private markets. So that's why there's some points I cannot contribute to the conversation because I have a different point of view. Because for me, it's like you have 100 euros to invest. So let's think about how to invest them best, to make use of correlation optionalities where you might find them, make use of risk premier approaches, and then obviously also make use of all instruments available. And